This is Will McCauley with cEntellect. I'm here with our founder, Mike Reed. This week we're going to go through our proprietary research and analysis piece, looking at the yield curve in the United States, its potential as an indicator for recession, and what a recession in the United States might mean for crude, natural gas, and power prices. So the yield curve currently is sitting around 33 basis points, and what that means is that the yield on the 10-year Treasury is 33 basis points higher than the yield on the 2-year Treasury. That's a pretty normal situation. However, in inversion, where the 2-year Treasury is yielding more than the 10-year, that's a fairly strong indicator of a potential recession. So that has happened 10 times in the United States in the past 60 years, and 9 of those 10 times have led to a recession. The last time led to a significant slowdown, but not technically a recession. So if the yield curve keeps going the direction it has been, we might be due for a recession in the next year or two. Mike is going to take us through a lot more detail about what the lead and lag associated with those factors is and what it potentially means for prices in the energy space in the United States. Mike.
Thank you, Will. The yield curve is a big deal, not a little deal. If we look at a chart on the left-hand side, we've matched up the 3 recessions since 1986. And we've matched that up with the New York Fed has an algorithm or a model that predicts recessions 12 months forward as a function of just the yield curve. So what we're doing in this chart, we're trying to get a quick snapshot on, is this an accurate predictor or not? There's 2 takeaways from this chart. The first is you see that the recession tends to come earlier than the peak prediction period. So the recession is faster than what the New York Fed predicts it is. The second takeaway from this chart is if you look at the current probability of a recession in 12 months, the New York Fed says it's about 11%. Well, you say, well, that's not really meaningful or material. Well, it is, because if you look at the first recession at the same time, their curve or their algorithm predicted about a 5% chance of recession in 12 months, and it happened. So that's one metric we can watch. The yield curve, also the New York probability of a recession in 12 months. Let's move to the right-hand side. The Federal Reserve continues to raise rates. And if they raise rates too fast, what do? They're lifting the front of the curve before the back end of the curve has a chance to equilibrate. And when you line up the numbers, you find, and this is almost eerie in terms of how accurate it is, about 79 days after the Fed raises their rate, the yield curve fully equilibrates it. So what I've done in this chart is I've gone ahead and pushed forward the yield curve 79 days after the Fed rate change. You see it lines up exactly. Fed rate goes up, yield curve comes down, and the inverse. And this brings up a huge question: is what causes the yield curve to go to invert it? Is it the economy? Is it the risk on the long-dated 10-year Treasury says that the risk is too high relative to growth, there's no growth, thus that's recessionary? Or is it the Fed raising short-term rates too fast before the yield curve has a time to equilibrate? So we're talking about a 79-day lag. Now there's another lag, and the lag is on the left-hand side of this chart. This lag says that after the yield curve goes inverted, a recession is imminent, but not right away. It is also eerie in terms of the lag is consistent at about 393 days. Not sure why 393 days, but we have a recession almost without fail 393 days later. Let's take a look at these 3 recessions. The first you can see, and this is again lined up with the 393-day lag, you can see that the first recession lines up on the first one between the yield curve and the recession. It lines up with the second one, and it lines up in a third one. So before we move on, Fed raises rates, 79 days forward, yield curve fully incorporates or equilibrates with those rates. 393 days later, there is a recession. Now, the question becomes, great, you've got a recession, what are the implications in the energy markets? And so the table does a pretty simplistic walkthrough. The first column is what happens to the equity markets. We're using the S&P as a metric. In the first recession, it actually went up 4%. That suggests the market was looking past a very short recession. The second, which was a little longer recession, the equity markets were down 8%, and then the Great Recession, it was down 38%. And so we were down 2 out of the 3 recessions, down an average of 14%. Let's move over to the US dollar. I think this is interesting. In all 3 recessions, the US dollar was up, and it was up predictably up 4% only, plus or minus 2% standard deviation. So in all three recessions, the dollar rose. Well, that brings us to crude. A rising dollar puts downward pressure on crude, and sure enough, crude fell an average of 11%. The first was a short recession. The dollar only rose about 2%, so crude actually rose 17% during the first. But the second and the third, it fell 30% and 22% respectively, so down 11%. Let's look at natural gas. Natural gas fell in all three recessions, and it didn't just fall, it collapsed. It collapsed an average of 34%, plus or minus 23%. And this is because of the tremendous demand destruction in the commercial sector as well as the industrial sector. So as that fell out from a demand side standpoint, gas stocks soared and the price of gas collapsed. Let's look at these now individually just to get a visualization of that table. The chart in the upper left is the S&P, and sure enough, in the right two scenarios of recession, it fell. The first scenario, it rose slightly. Let's move to the upper right and look at the US dollar. You can see the US dollar rose in all three recessions. In the bottom left-hand corner, you look at crude oil. You see crude oil was up, then down, down. And then natural gas fell precipitously in all three recessions. Let me close out with some takeaways. One of the takeaways is I just want you to remember there's a 79-day delay on any Fed rate changes. So looking at the yield curve today is not all that interesting. What you need to do is look at what the Fed did 79 days ago relative to today, and look at what the Fed's doing today. You need to fast forward 79 days. The second point is if it does go inverted, recession is, I would argue, imminent 393 days later. The third is the US dollar predictably rises in all three recessions, which puts downward pressure on crude oil. Crude oil is also a world commodity, not a US commodity. If the US goes into recession, the world doesn't necessarily go into recession, but the world does slow down. That's related. But we're dealing with a world commodity versus a regional commodity like natural gas. But US dollar rises, puts downward pressure on a world commodity, which is crude oil. And then natural gas predictably and materially falls, big number, average of 34%. Let's carry that through and talk about power briefly. If gas falls 34%, then that implies power is going to fall 34%. And what I mean by that is if gas is at $3 per million BTU, if it falls by 34%, let's call it $2 per million BTU. If gas is at $3 per million BTU with an 8 market heat rate, you have $24 power prices. That falls to $16 power prices if gas falls to $2. So gas prices for all the merchant generation could fall from $24 to $16 pretty easily during the next recession. And so in closing, the yield curve is real, it's important, it's this tremendous predictor of a recession, and I think we in the commodity space need to watch it closely. For that and much more information, please visit us at cEntellect.com. Thank you.